advantages of the tax-free savings account are actually its similarities to the RRSP, where you get the opportunity for high tax adjusted investment returns and tax advantage savings for housing or retirement or any other purposes. The tax-free savings account has the added advantage of also no withdrawal restrictions. Usually the conclusions about the two accounts are as savings vehicles for retirement are that they are very comparable for wealth accumulation and payouts. However, in some cases, the RRSP or TFSA appears more useful than the other. The different attributes that affect the usefulness of these accounts are about different types of retirement savers that we have and different goals that you might have for your savings. So with a proper understanding of these accounts and their attributes, savers are able to choose the right one for themselves and so they can enjoy better, higher tax adjusted payout in retirement. So now I would like to present the agenda for today's webinar. We are going to answer the following questions. What are you saving for? When should you contribute? How much can you contribute? What happens when you withdraw money? And finally, what are the tax implications? So what are you saving for? RRSPs, as many of you might know already, are very popular vehicles for putting money aside for your retirement and at the same time reduce your taxable income when you make those contributions. So usually RRSPs are used for retirement that's in many cases it's a common misconception because many investors think that that's the only purpose they should be used for is to save for retirement, but that's not fully true because you can, for example, use it to finance the purchase of your first home or to further your education. So in Canada, we have a home buyer's plan, for example, that helps you buy your first home. And you are allowed to take out up to $35,000 or $70,000 if it's a couple from your RRSP tax-free. Also, we have a lifelong learning plan, LLP for short, and it's a great way also for you or your spouse to finance your full-time education or training. You can borrow up to $20,000 from your RRSP, also on a tax-free basis. They have to be repaid over time, but initially, you can take it out on a tax-free basis. Now, TFSA, which is a newer vehicle since 2008 budget that created this account, allows you to also put aside money, and it's tax-free, and you can be save for all kinds of purposes to renovate your home. It could be to buy a car, start a business, for travel, but also as well as RRSP, it can be used to fund your retirement. And another difference that I would like to point out between RRSP and TFSA is that your RRSP cannot be used as a collateral for a loan, whereas TFSA can. So if you in the future need some loan, then you can definitely present your credit union or bank with the information about your TFSA, and you can use those assets to use as a collateral for a loan. It might be much easier and cheaper to obtain that loan. Many people think that TFSA, you can just easily take money in and out, which is true, but it also allows you to invest in many other investments and for all kinds of purposes, short-term and long-term. TFSA, stands for tax-free savings account. The letter S for savings could be a little bit of a misnomer and actually sometimes confuses many people because they think they can only invest in saving or high interest type of accounts or products, which is not the case. TFSA, like RRSPs and many other accounts, are open for all kinds of investments, you can invest in stocks, bonds, mutual funds, ETFs, which allows you to maximize the value of that account over time. Now, when should you contribute? For RRSPs, as many as you know, we have every year this RRSP season. And for this calendar year, 2020, that RRSP season ends on March 1st, 2021. What this means is that by that time, by that deadline, you're allowed to make contributions and use them against your income in 2020. There is no minimum age for RRSPs, but you must have earned income from the previous years to accumulate that contribution room. And usually earned income, it's your employment or business income. There's a maximum age when you cannot any longer contribute to an RRSP, and that's the age of 71. After that, you're not allowed to contribute to an RRSP. And with a TFSA, contributions can be made, throughout the year, and the minimum age is 18, and there is no maximum for TFSA. So at any age, you can contribute to this account in the future. Now, how much can you contribute to these types of accounts? With RRSPs, the government has a rule that you are earning 18% of your income to an annual maximum, which varies with inflation every year. For this year, it's $27,230. So if you have not contributed to the maximum in the previous years, you can catch up later. That earned room that you have created, which accumulates at 18%, is carried forward, and you can catch up later on. Now, you have to watch if you already maxed out your contributions to not go over that limit, because government has a penalty. You are allowed to over contribute by $2,000 in your RRSP without any penalty. So the government is allowing you to have a little bit of a wiggle room in case you have miscalculated your room. And now that $2,000 that goes above the limit is not tax deductible. And with RRSPs, you also are allowed to make spousal contributions, where you can contribute to an account that is in your spouse's name, but you actually are able to deduct that contribution from your income. This is a great way to split income down the road. If you have a situation where one spouse has a much lower income than the other, the higher income spouse would be, in this case, contributing to the lower income spouse's account. And down the road, when the lower income spouse takes money out of the RRSP, it will be taxed in their hands at a lower rate. Now, for TFSAs, again, they were introduced in 2009. And here you can see on the screen the limits for different calendar years. Initially, it's been 5,000, then it was increased to 5.5. Then we had 1 year where the contribution limit was 10,000. And now it's 6,000. And similar to RRSP, that contribution room is cumulative. So if you have not contributed in the past, you are allowed to catch up later. And so the current maximum, for example, is 69,500 per person. So it has become much a more substantial and useful account than it has been initially, because you can contribute a large amount and enjoy the tax-free growth over time. There's no spousal contributions like with RRSPs, and you're not allowed to over-contribute. If you do, again, the penalties are pretty steep, and they're the same as with RRSPs. It's 1% per month on the amount that is above the maximum. So it's very important to watch those limits. Sometimes what happens, you have investors opening accounts at different financial institutions, thinking that each account is treated separately, whereas that's not the case for the government. You know, it's all your accounts are pooled into one type of account. So if you over contributed into this account at another financial institution, you'll be subject to those penalties. Now, what happens when you withdraw your money? So with RRSPs, whatever you take out is added to your income for the year. So the full amount is taxed as your regular income. Be like, for example, when you get your salary, for example, there would be the same treatment for RRSP. And once you withdraw, you cannot recontribute that amount. You lose that contribution room forever. That's not the case with tax-free savings accounts. When you take money out, it's tax-free. So you don't have to report whatever you take out to the government when you file your taxes. And which is a neat feature of tax-free savings account, you're allowed to recontribute that amount again. You have to wait until the beginning of the next year. And then you can put that same amount back into the TFSA. So that's why it's a bit more flexible than RRSP for other purposes, short-term or temporary, like buying a home, a car, or going on vacation. You're allowed to recontribute that starting next year. So as mentioned about RRSPs, the tax implications of taking money out is that it's fully taxed in your as your income. And again, it doesn't matter if it came from investment income, your capital. Every dollar you take out of your RRSP is taxed fully at your marginal tax rate. So if you take money out in a year where your income is higher, you accordingly will be taxed at a higher rate. When you pass away, unless you have your spouse or a minor child or dependent disabled child as the beneficiary, in those cases you can roll RRSP over. Otherwise, the full amount is taxed as if you have withdrawn everything right before your death. So if you name your children or your nephew or whoever that is not a spouse or minor child, then basically the full amount becomes taxable upon your death. And the contributions are deductible from your taxable income. That's why RRSPs are quite popular among most investors, because whatever you put in could be deducted from your income for that particular year, and then you get a tax refund based on your marginal tax level. So if you, just to make the math simple, if you're paying 50% in taxes, if you make a $10,000 contribution, you'll get $5,000 refund from the government. Now with TFSAs, whatever you take out, again, be it income, capital gains, dividends, your original capital contributions, nothing is taxed. And so that contribution that you made before has already been taxed, so it's not taxed on the way out, as well as any income and growth you have achieved in that account. When you pass away, if you name your spouse as the beneficiary, your TFSA can be rolled over to their TFSA account without affecting their contribution room. So for example, if you and a spouse are at maximum with your TFSA room, and one of you passes away and has the other spouse as the beneficiary, the full amount can be rolled over to the other spouse's TFSA, even though they don't have any contribution room. If you have someone else, like your child, as the beneficiary, the amount is still tax-free upon your death, but the child might not be able to put it into their TFSA if they have already maxed out their own TFSA. So they can just put it into some other account like RRSP or a regular account, but it's not a rollover. And big difference between TFSA and RRSP is the fact that contributions are made on an after-tax basis and are not deductible like they are with the RRSP. You just in the current low interest rate environment, it's important to remember that both RRSPs and TFSAs can be invested in other vehicles than very low interest savings accounts. You have options to invest in many other products like stocks, bonds, mutual funds that can give you a better rate of return over time. Again, you should speak to your advisor about this and see if that would be something that would be appropriate for your situation. Thank you very much, everyone, for listening to the webinar. And now I'll open it up for Q&A.
All right. Let's see. Thank you, Roman. That was very informative. I got to tell you, I am personally a person who believes in both of these two great saving accounts. One thing that I learned, and I don't know if you actually covered that during your presentation, but one thing I learned, I think this year, is that the TFSA limit, there's a limit that you can contribute to a maximum amount. But if your investments grow to a higher amount and you withdraw some of them, you can then recontribute back up to that maximum amount that your investments grew. So that was actually very interesting to learn that.
Yes, yeah, that's a great feature of TFSAs.
Yeah, I had not been aware of that. I thought you could only contribute the maximum amount allowable, but not realizing that withdrawing your money leaves room for you. So anyway, okay, so here's a couple of questions. One is, and if you have any more questions, please type them into the chat box and I'll read them out. Will I lose my old age pension if I take money out of my RRSP when I retire?
It depends primarily on your income. Your income has to be at a very high level. I believe it's around 128,000 when you, like in retirement income, where you basically lose the whole older security benefit. So that's fairly large. Very few Canadians are actually impacted, by this, to have such a high income. But it does happen, so it's something to be aware of. Like around 80,000, you start losing the benefit partially, and then again, by the time you reach 128,000 or so, that benefit is gradually fully removed. So if you are in this kind of situation, that's something to be aware of, and you can speak to your advisor and design strategies to avoid that. So yeah, that's something to keep in mind.
Okay, and the next question is, with the interest rate so low, is it even worthwhile to open an RRSP, I guess, if you're a new investor?
Yes, the short answer is yes. We are right now in an extremely low interest rate environment, so that's a concern for many investors. The main advantage of RRSPs is that your contributions are tax deductible. And as mentioned during the webinar, you are allowed to invest in other products besides savings accounts and GICs. You could invest in dividend-paying stocks, for example, that can provide you with better income over time and income appreciation. In case of dividend growth investments, we had a webinar about that as well. And again, the longer your investment horizon, it allows you to take a longer term view and realize better returns with other investments. Again, it's something that you can discuss with your advisor or decide on your own what would be the appropriate mix of investments to meet your retirement and other goals.
And I guess I would point out too that that applies to other registered products, even for example, RESPs. And I use the example, I have my son's RESPs invested, in fact, with Roman Mlynko, who's our advisor, but they're invested in the stock market. And so not only does he get the matching funds that the government provides, plus the tax sheltering of the earnings, but he's also seen relatively significant growth in his portfolio over the years, so that, you know, by the time he's ready to go to university, he's going to have a lot more money than I would have been able just to save away without investing it. So, and this is even with the market having tanked during COVID, he's still doing pretty well in his portfolio. There's definitely benefits to looking at investing in the market, I guess, as opposed
it's about, you know, having the right mix, and it is important to look at your goals, investment horizon, risk tolerance. These are important factors to consider when deciding, you know, how to invest your savings. But it's good to keep in mind that these types of accounts are available to be used to invest in all kinds of products. So it's not like you have all these options with RRSPs, but not the TFSA or RRSP. They're pretty much all the same in terms of allowing you to invest in similar types of investments.
All right, thank you. Well, it doesn't look like there's any other questions. So Roman, I see you've put up your contact information. If anyone wants to call him afterwards to ask more questions, I'm sure he'll be more than happy to answer them. Also, we have recorded this, so I'll be putting it on our YouTube channel within the next day or so. And so you can listen to it again or send it to anyone else you know who might be interested. Thank you for joining us. Thank you, Roman, for explaining this to us, and we'll see you at our next webinar next week.
Thank you, Yuri, and thank you everyone for listening in.
You're welcome.